Now one talking point, an important conversation, because one bucket that has kind of stood out in different forms has been healthcare. I mean, individual pockets have really shown, there have been multiple companies getting the VAIs as well, and there have been some moves on that too. Aditya Khemka looks at this space very closely. Fund manager at InCred Asset Management, of course, needs no introduction, joins me. Aditya, just before I get to some specifics, because I wanted to talk to you about specifics today with you, we've spoken a bit about the macro, of course, but just a word on the earnings season. How have you seen that for healthcare at large?
So, good morning and thanks for having me, Neeraj. On the healthcare side, I would say branded generics, API, hospitals, diagnostics, they have all met or exceeded our expectations. On the unbranded side, there have been a hit and miss. So there have been few companies which have met our expectations, few companies that have missed. So it's been a mixed bag for the unbranded bucket, whereas for the branded hospital, API and diagnostic bucket, it has been largely met plus exceeded expectation kind of an earnings season.
Some specifics that I wanted to talk, Aditya, with you, because we're seeing some of the things stand out. Now, you were amongst the first one to tell me that the Revlimid benefits for some of the US focused companies will last for a while until they stop lasting, and the markets will discount that maybe 6 months earlier because the market is smart in its wisdom. Now, is Revlimid aided sale no longer a driving force for Reddy's, Sun and some of the others, and is the market now already looking forward for the life beyond Revlimid sales?
So I'm pretty perplexed myself that the market has probably not still discounted the fact that earnings will fall a cliff from once the Revlimid revenues go away. I think the problem here, Neeraj, is that these pharma companies which are selling Revlimid in the US market do not break out the quantum of sales or margins they make in a product like Revlimid. And therefore, each investor is left to himself to estimate what kind of earnings are coming from Revlimid, and hence what kind of earnings are at risk once Revlimid goes away in January of 2026. So my understanding still is that majority of these unbranded generic companies which are selling Revlimid in the US will see a flat to decline earnings year in FY27 when you compare the FY27 EPS to FY26, because FY26 will have probably 10-11 months of Revlimid and FY27 will not have any Revlimid sales. And I don't think the multiples which they are currently trading at indicate that that possibility is discounted yet.
Okay, so but are other things coming to the fore to help? Because there's a lot of talk about what the new administration will do to pharma. I think that is arguably a very big talking point currently, Aditya, and I don't think too many people have clarity about what it would mean. So I'm asking you to hypothesize, Aditya. I'm not asking you a question about from my end, but I'm asking you lay out what you think is your hypothesis, and if that turns out to be true, then what is the impact therefore on some of the Indian suppliers?
So look, from the new administration standpoint, we already had the Biosecure Act being passed in the US just before the new president took term. So clearly there is an anti-China, anti-Sino sentiment that is going to play out for the American or the Western part of the world. And from that, obviously, all the CDMO or CRDMO players in India will benefit. So I think that is something that is just as clear as day, and it will happen over a decade. It will not happen in a year or two, but it will happen over a decade. You will see material business moving from China to India over a decade. On the generic side, I don't think things will materially change because of the new administration, because anyways, Indian pharma companies supply products at competitive prices to the US market, which is desirable for the US healthcare ecosystem, and that should remain. So if you ask me what will incrementally change because of the new administration coming into power, I don't feel it will be anything different than what we have been saying for the past 2 months, 3 months.
Okay, Aditya, the social media chatter was also right that RFK Jr. is going to say that, oh, we want to dismantle the policies of big pharma in the US because American healthcare has been really impacted badly and they want to completely revamp this whole thing. So do you foresee that to happen? And if that happens, are Indian companies getting impacted in any fashion, positive or negative?
So if you look at it, Neeraj, if I were the in the American cabinet and looking at the American healthcare cost, 90% of the American healthcare cost of pharmaceuticals is from patented drugs, which formulate only 10% of their volumes. And then generic drugs are 90% of their volumes and only 10% of their cost. So I would probably be far more critical of how the patented drugs are being priced in the American market, and would probably look deeper into that and try to sort of get that cost down, right? And a part of which we saw late last month, where the Medicare Part D negotiations with the innovator drugs was allowed, and that would bring down the prices of some innovator drugs substantially, at least for a portion of the market, a small portion of the market, but a portion of the market. So I think the only 2-3 companies will probably get impacted from this will be companies which are selling innovator drugs in the US, which probably could be a Sun Pharma, potentially could be a Wockhardt, potentially could be a Lupin, where they charge very high prices in the American geography for an innovator product compared to what they charge for the same product in a European market or a Canadian market. And the reason for that being because America as a market allows you to freely price your product as long as it is patented. So from that standpoint, I think if the innovator drug price negotiations happen at a more broader scale, other than just Medicare Part D, you are looking at the specialty portfolio coming under some pressure in terms of pricing and profitability.
Got it. The other thing that a lot of companies have spoken about, Aditya, is this whole GLP-1 thing, diabetes, obesity, what have you. It seems that everybody's making a beeline for it. What have you observed here, and are there any company-specific impacts that can come about as a result of this?
Yeah. So this reminds me, Neeraj, of 2011 when the cholesterol drug atorvastatin was about to go generic, and there was a beeline for atorvastatin from every pharma company in India. So yes, it is a high volume drug. Yes, it is very effective. Yes, it is prescribed broadly by many physicians. But the fact is, if 10 people chase an opportunity, there is no longer an opportunity because it's an unbranded market. It will get commoditized. Pricing will get beaten down, and even the volume may be higher, the margins will be lower. So I am not so excited. Yes, there will be an intermittent 6-month, 1-year period where some players who will have a first mover advantage will make some money. But that 6-month, 1-year money is just one-time cash flow and cannot be given a multiple. And hence, I don't think GLP-1 will turn out to be such a material opportunity as many investors or many onlookers are believing it to be.
Okay, so you Aditya, in effect, sorry, just trying to get this straight. You are saying that while these are moves happening, and please correct me if I'm phrasing it wrongly, but until the proof of the pudding comes about in the eating, let's not preempt too many benefits or losses as a result of these moves.
So what happens in a bull market, Neeraj, is that you tend to discount the positives and you tend to ignore the risks. I think that is what is happening today. But if the market changes tone, then you will see the risks getting pricing in more and the opportunities standing more as optionality values. So I think that's what we are looking towards.
Okay, fair call. The other thing that I noticed, and I'm taking a leaf out of the MedPlus results today, Aditya. I'm not asking you to comment on MedPlus individually. I mean, you can choose to, but I'm just saying that I saw that their margins expanded a bit, and despite store count addition, their store-wise margins also expanded because apparently our analysis seems to suggest that private label sales moved up from 14% to 18% YOY. Now, is this something that I'm changing tracks here from pharma companies to, let's say, healthcare chains or distributors or what have you? But do you reckon that this could fast become a dominating theme or dominant theme into the numbers of some of these chains, and would therefore that be a bucket that you would closely monitor / be inclined to invest in?
Right. So, Neeraj, white label sales from pharmaceutical chains is something that has baffled me for a long time. To my understanding of the Indian law, changing the prescription or switching the prescription from a prescribed drug to your own white label is something that the Indian law doesn't allow. That is point one. Point two, I don't think doctors prescribe the white label of a pharmacy chain because I don't think pharmacy chains promote their brands to the doctors. So I actually do not understand the legality aspect of this business at all. And for that reason, something that I don't understand, I don't invest in. So we stay away from such investments because I don't know how this white label thing plays out so you can do white label in electronics. There is no law in electronics that if somebody is searching for a OnePlus product, you cannot sell him an Amazon product. But in pharma, to my understanding, there is a rule that if there is a prescription saying brand A, you have to disperse as a pharmacist brand A. If you disperse any other brand, you are essentially violating the law, although the law may not be enforced today. But I don't understand how this happens in our market, and I don't understand the legality of it, which is why I stay away from such businesses.
Okay. So, well, and viewers, MedPlus should pull that up because the numbers look very impressive. Just want to mark that. Remember, Aditya is not talking about that one individually, so please bear that in mind. But just wanting to mark it, it's up 3% today. But Aditya is saying that there are a few things that an XYZ company might be doing, which are difficult to comprehend, and therefore better to stay away from something that you can't quite understand. Aditya is saying he doesn't understand. You understand. Good luck to you. Please go out and try and invest, of course. So keep that in mind. Okay. Now, Aditya, the numbers from divis were that big positive surprise, right? And maybe you will argue that it was not a surprise for you, but it was a surprise to the street at large. What I want to understand from you is that do you reckon that some of these companies are entering a bit of an up cycle because of capacities or contract manufacturing, so on and so forth? And could the market give high multiples to these businesses because they are cyclical, and at the upswing of a cycle, typically in the past they have tended to enjoy higher or even higher multiples than what they're enjoying right now? What would you do in such a scenario?
So, Neeraj, fundamentals of equity investing dictate that when the margins are at cyclical lows, you ascribe higher multiples so that you are closer to the fair value of the investment. And when the margins are at cyclical highs, you ascribe lower multiples so that you are closer to the intrinsic value of the investment. However, equity markets being what they are, when the multiples come at cyclical lows, the lowest multiple gets ascribed, which gives you an opportunity to buy. And when the margins go at cyclical highs, the highest multiple gets ascribed, which gives you an opportunity to exit. However, people get caught in momentum, and they think if a stock is going down, it will continue to go down, so they sell at the lows. And then the same thing, the opposite also happens when the stock continues to go up because margins are looking up. People buy at the top, and then they lose capital because the margins tend to mean revert. So this is just from a cyclical investing standpoint. Now, coming specific to something like a Divis or any API player in India for that matter, the fact that Divis or these API players tend to have a CDMO innovator portfolio will give their numbers some cyclicality in terms of quarter-to-quarter volatility or year-to-year volatility sometimes, because innovator products can be very lumpy in terms of the margins and in terms of quantum of sales that they give you. So one has to be very, very aware of, at what margin am I entering the stock, and at that margin, what is the multiple that I'm paying for the stock. If the margin is on the higher side and the multiple is on the higher side, it is very likely you may make money for 6 months, 12 months if the margins continue to inch higher. But once the mean division of margin happens, the mean division of multiple will also happen. And it is very likely that you will lose capital over a medium term. Similarly, when you invest at a lower end of the margin in the down cycle, and you're paying a lower multiple than the average multiple of the stock, then you may lose capital for the next 1 or 2 quarters if the margins continue to go down. But over the medium term, you're very likely to make handsome returns because margins will mean revert and the multiples will mean revert with it, and which will give you a high return on your investment. So specific to Divis, I am not really sure how much they talk about their innovator pipeline and their innovator supplies and the sustainability of those supplies. And honestly, I don't think these CDMO players have enough visibility to talk about it, because the innovator knows the inventory situation. They don't know the inventory situation. So they honestly don't know how much sustainability of these cash flows are. But from an investor standpoint, I would rather invest when the margins are cyclical lows rather than when they're at cyclical highs.
Okay, point well taken. Aditya, where is it that you are most constructed now within this bucket? I mean, there is pharma, there is CDMO, there is API, and chains, diagnostic chains, and hospitals, of course. Where is it that you are most optimistic right now?
So most optimistic I am today in hospitals. There are a couple of stocks that we own where we feel valuations are just too cheap to ignore, and the business models are fairly sturdy and robust. And we continue to be extremely bullish on diagnostics as well, because as we had discussed in the past earlier, the volume growth in the brick and mortar diagnostic chains continue. The pricing power exists, and they are increasing pricing as we speak, and that will lead to operating leverage and better margins and better ROEs. So mind you, on the diagnostic side, we like to play the affordable players, and same goes for the hospital side. So we like to play the affordable guys rather than the premium pricing guys, because we feel the premium pricing guys are kind of tapping out their potential of margin growth, whereas the affordable guys, have far more runway for growth when it comes to their growth potential, because the affordable segment is just too large compared to the premium segment, which tends to be smaller in terms of volume.
Got it. Okay, and just one last question, because when you saw the results as well and the commentary from Apollo Hospitals, there was a fairly constructive there. Is this, even if valuations are expensive, would the nature of growth and higher growth take care of some of the expensive valuations, Aditya?
It does. So if you look at hospital stocks, especially if you look at the Apollo stock price history, right? Let history tell you what will happen in future. So Apollo has had, or these hospital stocks do have 3-4 year periods when there is zero return, whereas the business continues to grow. Now that happens because the multiples in the period prior to those 3-4 years would have been taken to a level where the multiple just cannot re-rate any further. And therefore the business has to grow and compensate for the multiple to come down over a period of time till it becomes affordable. And then again, the next leg of stock performance comes. So I'm very, very sure Apollo will do a great job as a company in terms of growth in top line, EBITDA and bottom line and cash flows. But in terms of the multiples, I think, a lot of that growth is getting discounted in the current stock price.
Okay. Aditya, such a pleasure talking to you. Thanks so much. It's a complex subject. You always simplify it for us. Really appreciate your time.